Hello, traders. Welcome to Leading Forex YouTube channel. My name is Kofi, your admin for this channel. It's actually a great day, and I'm happy today you are seeing me face to face. I'm so glad that gradually we are making progress on this channel. I'm beginning to set up some few equipments in order to make this whole tutorial thing lively. I believe that it shouldn't just be you hearing my voice without seeing my face. So I'm putting things together with the help of Forex trading. I'm getting some few things that I believe will be able to have a very good or fruitful interaction on this channel. Today is another tutorial. I have another session of tutorial for you. If you are new to this channel, we provide two main things on this channel for now. Maybe in the near future, we may be adding other things. But for now, we provide free tutorials on this channel. And also, we provide free signal or forecast on this channel. So when you go to this channel, we have two playlists. That is the free Forex training playlist, and then the free signal, which is the Forex signal playlist. Any of these playlists, I am sure and want to believe will do you a lot of good. So please feel free, go to the free Forex training playlist, watch all our tutorial videos, if only you want to become a Forex trader. Is that okay? Now, in case you also want to just follow our signals, then go to our signal session, which is the playlist, the Forex signal session. Watch some of the playlists or some of the videos that are on that playlist. And once you are okay and you feel like you can follow us for good, then join us by subscribing to this page or subscribing to this channel, because we have a lot coming, a lot. And I can tell you we have a lot. Is that okay? So we are continuing from our tutorials. And today we have another episode for you. So if you're ready, without wasting much time, I want us to go and watch the slides and see what we have for ourselves today. Now, in today's video, we will be talking about margin. You remember in our last episode, we talked about margin. And in that margin trading, we talked about account balance, I think. Yes. So today, we're going to talk about the margin itself so that you know what is margin. Is that okay? So let's go straight up. Let's go and see what we have for ourselves today. Margin. All right. So because I want you to see some things very clear, I want to put off the video or take it off for now. And as we go on, if there need be to bring it back, I'll surely bring back the video. All right. So that's that. Okay. The video session is off now. So let's continue with our lesson. Now, today, we have a few things to talk about. And just a recap. In our last episode, we talked about margin trading. And also, we talked about some things we need to know under margin trading. And some of them we said are the balance, the used margin, free margin, realized or unrealized profit or loss, equity, and then margin level. These are the topics. And in our last episode, we talked about balance, realized and unrealized profit or loss. So today we're going to talk about margin itself. Okay. So now you already know how to get in touch with me when it comes to you getting in touch with me for us to talk or anything. These are my contact details. Now, Leading Forex, our main aim is to become the alternative in the status quo that you are stuck in. Whatever venture has kept you at bay, that you are not able to find a way forward. Anything that is holding you back in terms of making money online. If it is Forex, then we got you covered. If it's about other ventures like crypto, we have that playlist that will be coming very soon. The playlist for crypto. Yes, it will come very, very soon. That will be for the investors, those who want to hold some monies for a longer period of time to make some ends meet or make some monies out of it. That will be about the crypto. The playlist will come soon. But here we are on Forex. So let's continue. Now, there is this message I received, and I want to quickly talk about it. Please pardon me that I'm taking a lot of your time. Okay. Now, I received this email from one of you on this channel who is watching always. His name is Daryl Smith. Daryl Smith. Daryl Smith, thank you very much. I don't know if I'm pronouncing the name well. Daryl Smith. God bless you. And the message says, "Hi, Kofi. I hope you are well. I'm grateful to you for the videos that you produced. I have watched a few of them and they have helped me tremendously. I would like to send you a small token of my appreciation in the form of cash. How can I do that? Do you have PayPal? Thank you." This was the message Daryl sent to me. And after I responded to the mail, he actually sent me money. He sent me some dollars. And I want to appreciate him on this channel because I know he is watching these videos. Even if he doesn't see this, I want to appreciate him. It is good to say thank you to people when they do you good. So in my own small way, Daryl, I want to say thank you on this channel for that gift, for that little token that you said you had for me, which actually came to me. I appreciate that a lot. God bless you so much for me. I pray that the reason you came to this channel, you will find it and become, I don't know how to put it. I want to get a word, but in any way, God knows my heart, how I feel, and what I wish for you. All right. Now, I am not showing you this message to mean that you should also begin to send me money or gifts or whatsoever. That is not the reason for sharing this with you. But I just want you to know that what I'm doing here is helping some people. And so if you are also here, it might help you. You may only have to take your time, and I'm sure it will help you. That is the message I want to communicate. It's not about the gift he sent to me. It's just about letting you know that you can also stay here and get something good. Okay? Thank you. Once again, Daryl, I appreciate it. God bless you. Now, let's go to the business of the day, margin. Now, this topic is very, very important to me, and I want you to pay critical attention. It is all about the Forex thing that we are doing. Once you understand margin, you understand everything in Forex, right from the word go. Yes. So I want you to pay attention. Every Forex trader, this is one of the most difficult topics a lot of people are skipping. I mean, the content creators on YouTube, most of them are skipping this topic because they do not actually understand it, or they understand it, but the way to express it for you to understand is quite complex or difficult. But I'm going to try my best and break this topic down to its lowest or least way of understanding. I pray that I achieve that. Okay, so margin. Let's read some notes. We are saying here that margin, when trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. Now, this capital is known as margin. Yes. When you open your account, the money that you deposit into your account, which is your balance, that amount is also called margin. Now, why are we saying so? Now, let's continue. We are saying so because, for example, if you want to buy, for instance, USDJPY, which is worth $100,000, because you are a margin trader, you don't need to put up the full amount. You only need to put up a portion of the amount. And the actual amount required will depend on your broker. I mean, the broker that you use. Now, in practical terms, what we are saying here is that you want to buy Euro USD or USD JPY, $100,000. You don't need to get this whole money to put in your accounts before you can buy. You only need a portion of it, and you soon understand what will be that portion that you need. So in simply terms, margin can be thought of as a good faith deposit or collateral that is needed to open a position and keep it open. So all that we are trying to say is that margin simply means a collateral or a good faith deposit. Collateral in the sense that you want to buy $100,000 of USD JPY. But the broker is saying that you don't need to deposit all this, which is the 100,000. You only need a collateral. We only need a collateral from you. So maybe the collateral will be maybe just $200 or $500. So once you can deposit maybe $200, $500, $1,000, we will give you the access to trade $100,000 or buy $100,000 worth of USD JPY. Do you understand the analogy here? So the deposit that you put into your account is actually a collateral that is going to allow you trade bigger amounts of money. If it is still not clear, don't worry. It is going to be clearer as we move along. So it is a good faith assurance that you can afford to hold the trade until it is closed. Margin is not a fee or a transaction cost. Margin is simply a portion of your funds that your Forex broker set aside, which means it's locked up from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. Once the trade is closed, the margin is freed or released back into your account and can now be used again to open a new trade. Now, all we are saying is that, for instance, let's say you go straight to an institution, a bank, to ask or request for a loan of say $10,000, okay? Now the bank or the institution will tell you that, okay, we can't just give you $10,000. You need a collateral. You need to find out what we call affordability. We need to be able to make sure that you can pay back the $10,000 that you want. So if it is your salary that you want to use as collateral, they will use that. If it is your house, your building, your property somewhere that you want to use as a collateral, they look at that, and based on that, they give you the $10,000 that you are looking for. So the amount of money the institution has given to you is based on the collateral. The same way in Forex. If you want to trade a certain quantity of currencies, they will demand a collateral from you. And that collateral is money that you deposit into your account. So the money that you have in your account will determine your affordability. Do you understand? The level of money you have in your account as your balance will determine your affordability. I mean, what money you can actually buy, or what currency you can actually buy or sell. Or, for instance, if it is a loan, the money you have in your account will determine your affordability, what the bank should give to you as a loan. I'm sure we might have all done this before. If you are someone who has ever taken a loan from a bank and you are using your salary or your money sitting in the bank as collateral, the bank will need to look at your money, which is called affordability. And based on that money, they are able to decide and say, okay, based on this money that you have coming in every month as salary, or based on this amount of money you have sitting in your bank account, we can be able to offer you this amount as a loan. So at that level, your monthly salary or that money you have in your account becomes a collateral. The bank is looking at that to be able to decide what money they should give to you. The same thing in Forex. Now, if it is still not clear, it will become clearer as we move along. Stick and stay with me here. Now, do you remember this video? If you don't remember this video, I will entreat you to go back to the part 35 video on this playlist, which is the Free Forex Training playlist, and watch this video. If you do remember, we talked about lot sizes, and we said lot sizes are units of currencies that you buy, if you remember. So if you want to buy, for instance, 100,000 units of any currency, we call that a standard lot, which is 1.0 upwards. If you want to buy 10,000 units of a currency, that will be termed as a mini lot, which ranges from 0.10 up. And if you want to buy 1,000 units of a currency, that will be termed as a micro lot, which is 0.01. And if you want to buy just 100 units of a currency pair, you need to have what we call the nano lot, or use what we call the nano lot in doing that. Now, this is going to make sense in this video because when you want to buy 100,000 units of a currency, it simply means $100,000, $10,000, $1,000 of a currency, $100 of a currency. If you want to buy any of this, what you use is lot sizes, which is standard, mini, micro, or nano. Now, the reason this is going to make sense is this. Let me continue and then I'll come back here. Now, let's look at this example here, okay? For instance, you want to buy Euro USD. You want to trade Euro USD. And you want to buy or sell it at $100,000. Okay, without a leverage. Now, this is going to be a video that will explain both margin and leverage at a go. Listen, you want to buy or sell Euro USD, $100,000 of it without a leverage. If you want to do that without a leverage, what it means is that you will need to deposit exactly $100,000 into your account before you can buy Euro USD $100,000 or sell Euro USD $100,000. It means if you want $100,000, you should have $100,000 in your account. That is, if you don't want to use leverage, if you don't use what we call leverage, what it simply means is that if you want to buy or sell $100,000 of Euro USD, you will need $100,000 in your account. But because this money is so huge and not all of us can afford to get $100,000 in our account. And remember, $100,000 in your account simply means you want to use a standard lot size, which is 1.00 upwards. If you want to use any of those lot sizes, what it simply means is that you are buying 100,000 units or $100,000 of Euro USD or whatsoever currency. So it means before you can use a standard lot, if you don't want to use what we call leverage, then it means you need to have exactly $100,000 in your account before you can even sell or buy Euro USD with a standard lot size. But because our brokers know that we do not have such monies to deposit, they have decided to give us what we call this money on collateral base. So in order to give you access to trade this huge amount of money on collateral base, they have asked you to choose what we call leverage. So the leverage that you will choose will determine what type of margin or collateral you want to use with your broker. Because every leverage that you choose simply means you want to trade in a certain collateral range, certain terms and conditions, okay? So what happens is that, let's go to the next point. But once you choose a leverage, it means you want to trade with margin or what we call collateral. And the leverage you choose will come with its terms and conditions, also known as margin requirements, which is often in percentages. So once you choose a leverage, what you are doing is that you are telling the broker that you want to trade with a collateral. You want to trade on margin basis. You want to trade on collateral basis. And the leverage that you will choose will come or determine the terms and conditions that you want the broker to give to you. And so the broker has been so flexible that they have given us different leverages. So once you are creating a live account, you are asked to choose different leverages. You have about 3 or 4, depending on every broker and their number of leverages that are available. So they give you the option to choose what leverage. So the leverage you are choosing simply means that you want to trade on margin or you want to trade with a collateral. So every margin or every leverage will come with its terms and conditions. So if you choose a leverage of 1:200, it will come with its terms and conditions in terms of margin, or the collateral will have its terms and conditions. If you choose a leverage of 1:100, it will come with its terms and conditions because you are choosing a certain margin, and that margin you are selecting will come with its terms and conditions. If you choose 1:50, you are choosing that as your margin, and it will have its terms and conditions. Now, you will soon understand the terms and conditions. Let's quickly move on. All right. I pray that you understand this as we move along. Now, this will make things very clear. Now, let's go to this typical example here. Let's say that you want to buy or sell Euro USD, okay? And you want to use what we call standard lot, okay? Euro USD. Pardon me if my writing is not good. Okay. You want to buy or sell Euro USD, and you want to use what we call standard lots. Standard lots, what it simply means is that you want to trade Euro USD $10,000 or $100,000 or 100,000 units. Okay. Now, whilst you have this at the back of your mind that is what you want to do, you go to a broker and then you create an account. And then the broker will ask you that what leverage do you want to use? And then you select a leverage you want to use. Okay, fine. I don't know what leverage you selected. But let's assume that the leverage that you selected came with this margin requirement, which are the terms and conditions. Okay. Let's assume once again, I'm trying to say this over and over because I want it to sink very well. Okay. You decided to choose a leverage. I don't know what leverage you selected or took. I don't know what leverage you selected or took, but let's assume that the leverage that you took or selected came with a requirement of 2% margin requirement. If that leverage you selected came with this margin requirement, what it simply means here is that if you want to trade 100,000 units of Euro USD, you will need to have an account balance of $2,000. That means if you want to use a standard lot, which is 1.0, it means you will need to have $2,000 in your account. If you want to trade Euro USD, $10,000, then it means you will need to have a balance of $200, which is going to be your collateral. This is going to be your margin that is going to be required from you. So that is 0.10, which is the lot size. So if you want to use a lot size of 0.10, which is the 10,000 units, it means you need to have a margin of $200 in your account. If you want to trade the same Euro USD with the leverage that you selected, the leverage you selected says that 2% margin requirement. Okay. So if 2% margin requirement, then it means that if you want to trade 1,000 units of Euro USD, which is the same as $1,000 of Euro USD, then you need to have $20 in your account as margin. The same way, if you want to trade just $100, okay, in your account. So that with the $20 margin requirement, it means you want to trade 0.01 as a lot size. If you want to use a lot size of 0.01 in your account, then you need to have a minimum of what? $20. And if you want to trade just the 100 units, then it means you need to have you need to have just $1, not 0 point. You need to have just $1 in your account before you can trade the nano lot, which is 0.001. Do you understand this scenario? Let me take it again. Now, you created an account and then you selected a leverage, or you decided to choose a leverage. The leverage that you selected came with a requirement of 2% margin requirement. What it simply means is that if you are going to be using a standard lot, which is you want to buy any currency at this unit, which is 100,000 units, it means you need to have $2,000 in your account, which is the margin requirement. If you are going to be trading a lot size of 0.10, which is the 10,000 units, you need to have $200 as margin requirement in your account. So 2% margin. So 2% of $100,000 is going to be $200. And then 2% of $10,000 is going to be $200. So the broker is requesting for you to have $200 in your account if you want to trade this lot size. And if you want to trade $1,000 as a unit, then you should have at least $20 minimum in your account, which is going to be the margin requirement. And that will bring me back to the lot size video or section that I just talked about. So you see the units here. If you want to trade 100,000 units, which is the standard lot, and the margin requirement is 2%, it means you need to have $2,000 in your account. If you want to trade with the mini lots, which is the 10,000 units, 2% of this will be what? 200. So you need to have an account balance of 200, or a leverage, sorry, a margin of 200. Okay. If you want to use the micro lot, which is just the 1,000, you need to have a margin of what? $20. And then in that order. Please, do you understand? Depending on the broker leverage that you selected. So this will be your margin requirement. Now, if this is the case, now this is where it gets interesting. Okay. Let's say you deposited $1,000 in your account. Please take this part very serious. Let's say you deposited $1,000 in your account, okay? And we are already saying that margin simply means that a collateral that is set aside on your account in order to allow you to take a trade, or to allow the trade to run until you close it. Okay, so you deposited $1,000 in your account, and then you want to trade with a standard lot. So with $1,000, if the leverage that you selected says 2% margin requirement, and you want to use a standard lot, You will enter the trade and the trade will reject. The reason being that the leverage that you selected says you need 2% margin requirement, and 2% margin requirement will be $2,000 in order to use a standard lot. But you have just $1,000 in your account. So based on the leverage that you selected and then the margin requirement on that leverage means that if you have just $1,000, you cannot trade a standard lot, which is the 1.0, because the margin requirement is $2,000, but you have just $1,000. So you select a standard lot, you enter the trade and you see the trade rejecting. The reason it is rejecting is because your leverage is giving you a requirement that you do not have in your account. Do you understand? But again, still you have $1,000 in your account. And then you decided that you want to trade with a 0.10 lot size, which is 0.10, which is the mini lot. So if you want to trade with this lot size, per the leverage that you selected, the leverage is saying you need 2% margin requirements. Your $1,000 is more than $200. So it means you can use this lot size. Now, when you enter a trade with this lot size, your broker is going to set aside $200 from this, your balance. You have $1,000 in your account as balance, but your broker will set aside $200, which is the collateral. They are going to set aside $200, but you will not see it, that it is deducted from your account. Your account balance will still be 1,000, but you will see margin requirement of $200 set aside. So it means that your margin is no more $1,000. Your margin is now left with $800. And so you will see on your trading platform, when you go to the account balance section, you will see free margin. And you see free margin 800, or you see 800%. So once you see free margin 800%, what it simply means is that, should it be 800% or 80%? Come on, where are the mathematicians? Okay, I think it's going to be 80%. So you see free margin 80%. Okay, it means that you have entered a trade which has taken $200 as margin. So this $200 that has been taken as margin will be called used margin. Used margin. So now $200 has been used as a margin on your current trade that you have opened. So you only have 80% of the margin left, which is $800 is what is left. If you open another trade again with another lot size of 0.10, what it means is that another 200 is going to be deducted as a lot kept somewhere. It's going to be set aside again for the next trade that you have opened. So at that point, your used margin is going to be what? $400. And then your free margin is going to be left with what? 600, no more 800, because you have placed two trades. And each of the trade is taking a margin of 200, 200. So now your used margin is now 400. And then your free margin is now 600. So you see free margin 60%. Okay. You will see free margin 60%. And then you see used margin 40%. If you decide to enter another trade again, which is the third trade on the same account, another 200 will be set aside. So at this level, your used margin is now going to be what? 600. Your used margin is going to be 600. And your free margin is going to be what? Your free margin is going to be left with 400. So in percentage, you will see used margin 60%, And then free margin, 40%. Because you are left with just $400 because you have opened 3 trades and each of the trade is taking $200 as margin. So you have entered 3 trades. Those 3 trades amount to $600 as used margin, meaning you have only $400 left as free margin. Now, let's assume you decided to add the 4th trade, another 0.10. So at this point, your free margin is just left with just $200 because you have entered 4 trades and each of it is taking $200 as collateral. So you have used 1, 2, 3, 4, which is $800 as collateral, and you are only left with what? $200, all from your $1,000. You will still see your $1,000 standing. Okay, you will still see your $1,000 standing. Okay, good. Now, what happens? Let's say you decided to add a 5th trade because the remaining $200 can still have access to 1 more trade. So you decided to use the last free margin on your account. So at this point, you have entered the 5th trade. So now your free margin is now 0.000 in percentage. You don't have a free margin anymore. But your used margin is now 100%. So your used margin is 100%. Your free margin is 0%. It means you don't have a free margin anymore. So if you decide to add a sieve trade, let's say you decided to add another trade, which is the sieve trade. At this point, you don't have any margin again. So when you enter the sieve trade, you will enter the trade and the broker will reject the trade. The reason the trade is being rejected is because you don't have any free margin anymore. So you cannot add a sieve trade. The only time you can add another trade is when you have margin. So how do you get margin? It's either you top up your account or you close any of the running trades. If the trades run in profit and you close them, your margin is going to increase because once you close a trade in profit, it means your account balance is going to be more than it used to be. So it means you are going to get extra money on your account. So it's going to give you extra leverage. Okay. So let's say you close the first trade at a profit of $100. So once you close the first trade at the profit of $100, what is going to happen is that immediately you close the trade, your account balance is now going to be 1,100. Let me clear this so that you can see things well. You have 5 trades running and your used margin is 100%. Your free margin is 0. You don't have a free margin. If the first trade runs into profit, okay, and you get a profit of $100 and then you close. So this is your $1,000 and you have made a profit of $100. Once you close your first trade, your account balance will now become 1,100. So once the account balance is now 1,100, you have closed the first trade. So your margin that was set aside, which was $200, is going to be released back to you. So your used margin is going to be $200 plus the profit that you made, which is $100. $100 profit is 100. So your free margin is now going to be 300 because you still have 4 trades running. So you now have a free margin of what? 300 because you closed 1 trade that was using a margin of 200 and then you made a profit of 100, which is adding up, giving you a free margin of 300 now. And then a used margin of what? 800 because you still have 4 trades running. Now, if these 4 trades, let's assume you didn't make profit, you made a loss. Okay. Just the same way that you made profit and the profit came to add up to the account and then your margin increased. The same way when you make a loss, your account balance will reduce. And once your account balance should reduce, it means that your margin has also reduced. Now, once you close the trade at a loss of $100, okay, you have 5 trades running. You don't have any free margin. You decided to close one of the trades at a loss of $100. What it means is that $100 is going to be subtracted from your account balance, and your account balance will be left with what? 900. Now, the 200 margin that was used on this account is going to be released. So you are going to have your 200 margin back. But the painful aspect of it is that your account balance has reduced to 900. So this 900 is where the calculation for the remaining 4 trades running is going to be made. Although your 200, which is your margin, was released, but the 4 trades that are running are all using, each of them is using $200 as what? Margin. So it means the 4 trades running is going to have $800 margin used. And your account balance is now 900. So it means how much is left as margin? Your margin is only left with what? 100. Although the 200 was released, but because you were in a loss, your account balance reduced to 900. And of 4 trades that are running are using a margin of 800 already. So although 200 was released back to you as margin, but because you made a loss of $100, the account balance is now 900. So the remaining 4 trades are using 800 as margin. So what margin is left? Your account balance is 900. And 4 trades are running, which is using a margin of 800. So you are just left with $100 as margin. And with this $100 left as margin, you cannot add another trade because you need $200 as margin to enter a new trade. Meanwhile, your margin is only left with what? 100. So once this trade you keep on losing. Let's say that now you decided to close out of the remaining 4 trades, you decided to close the 3rd trade. Or you decide to close another trade with a loss of $100. With a loss of $100. So now, immediately you close this trade, your 200 margin that was taken is going to be released. Now, what is going to happen? But because you made $100 loss, $100 will be subtracted from the remaining 900. Remember, you closed the first one at a loss of 100, so you are left with 900. You close the second one at a loss of 100, so you are left with what? You are left with 800. So your balance is now going to be 800. Now, you don't have 4 trades running anymore. You have only 3 trades that are still running. So the 3 trades is using a collateral of what? 600. Because each of them is using a collateral of $200, which is margin of $200. So now your account balance is $800 because you lost another $100. 3 trades are still running now with a collateral of 600. So what is your free margin now? 600 is still running. Your balance is 800. It means you are only left with 200 as free margin. So with $200 as free margin, maybe you can add additional trade because you fall between the $200 margin level. But will you want to add or choose not to add? That will be your decision. So when it comes to margin trade, this is what is made. So once you continue making losses, and it gets to a point that your margin, you close, let's say you close the next trade at a loss of maybe 200. So your account balance from 800, you are left with just 600. You are left with 2 trades running. The 2 trades are using a margin of what? 400. So your free margin is left with 200. Let's say your remaining 2 trades, the next trade gave you a loss of what? $300. So you are left with just $300. And you have just 1 trade running at a collateral or at a margin of what? $200. So this $200, once you subtract it from the remaining balance, which is $300, you're left with just $100 as free margin. Now, let's say the last trade that is using a margin of 200, okay, makes a loss of $200. Once it makes a loss of $200, what your broker will tell you is that now your last trade that is left is in a loss of $200. When you subtract $200 from $300, you are left with $100, which is not enough to be a margin to hold your account. Do you get it? You are left with $300 after you close your first 4 trades. And then the one trade that is left that is running is in a loss of what? $200. Since it is also in a loss of $200, you are only left with $300. Now, a margin of $200 is needed to keep your account running. Now you are in a loss of $200. So when $200 is subtracted from the $300 that is left here, you will be left with just $100 free margin. And this $100 free margin is not enough to hold your trade, because you need to have at least a free margin of what? $200. But you are in a loss of $200, and the remaining free margin that is left is not up to $200. So what your broker will tell you is that you have received what we call a margin call. And once you receive a margin call, you receive what we call stop out. Your trades will close automatically. Your trades will automatically close. And once they automatically close, what I can tell you is that at that moment, you have blown your account. You have blown your account. So when we say that you have blown your account, it means that you were in loss and didn't have enough free margin to keep holding your account or your trade. Remember, we said that margin is a collateral that is taken from your account to keep your trades running. But since you don't have free margin, you are in a loss. Your account balance is 300 and you are in a loss of 200 already. So when this 200 is subtracted from 300, you are only left with $100 free margin. And this $100 free margin is not enough to hold your account, because the leverage that you selected says that you need at least a free margin of 200. But you don't have a free margin of 200. You only have a free margin of what? 100. So you receive what is called a margin call. Margin call, it means you don't have margin. A margin call simply means you don't have margin. You don't have a collateral anymore. You don't have collateral that will hold your account running. So if that happens, you receive a stop out. It means your account is going to be what? Taken off automatically. Your trades will be taken off. They will be stopped automatically because you don't have free margin. And then you see that your account is blown. What blow account? That is how in Ghana they will tell you you have blown your account because you don't have collateral. Does this make sense? If it doesn't make sense and you still have questions, put them below. Write it below for me. Write it at the description of this, the comment section of this video. I want to hear you if you still don't understand this. So this is what happens when we say free margin, used margin, margin. We are all margin traders, okay? We are all margin traders. Now, permit me, if it's off, let me bring it back again. Like I said, we are all margin traders. So since we are all margin traders, what we need to do is to learn and to know how to use our account wisely. Depending on what leverage you choose will determine what will be your margin requirement. And again, the currency pair that you will choose will also determine leverage requirement, your margin requirement. There are some currency pairs that would demand extra high leverage than others. Yes. So you need to be sure you know all this before you know what you are doing by placing a trade. So it is always good that once you know your margin requirement, you make sure that you enter your trade with caution because you know what leverage you are using. Now, one may want to ask me that, okay, how do I know that this account, the leverage that I'm using, is going to give me this, what do you call it? This percentage of what? Margin requirement. Now, to make it so easier and simple, let me share this screen and just show you this. This video is already long, but I think I should just do this once and for all. Are we good? Okay. Now let me off the video again. Now, if you can see my screen, I quickly want to give you the calculations. Okay. So that you know that, okay, the account that I'm using, this is the margin requirement based on the leverage that I chose or selected or taken. That is the English. Okay, so if you are using a leverage of 1:100, 2% is required. Margin requirement, 2% of your account. 1:100, a leverage of 1:100. Okay. If you choose a leverage that is lesser than this, maybe 1:50, it means this leverage will also reduce. It means the leverage will rather increase. So it means more leverage will be required from you. If you choose below 100, more leverage will be required from you. If you choose above 100, less leverage will be required from you. That's why you see some brokers offering you a leverage up to 1:500. They are offering you this huge leverage because they feel like they want your margin requirement to be something very small. So maybe with this leverage, 1:500, you may have a leverage of, a margin requirement of maybe 0.05 or 0.5, which is half. Okay, this is not even up to 1%. 0.5% is required. Okay, this is quite better because if 0.5% is required, or maybe even lesser than this. So when you are using the leverage that is more than 100, you have less leverage requirement. And if you use a leverage that is below 100, more leverage is required. More margin is required. More margin is required if your leverage is below 1:100. And then less margin is required if you are using a leverage which is above 1:100. I'm sure I have answered you, but in my next video, I will definitely demonstrate this again. The leverage issue, I'll still demonstrate it, okay, so that you can understand better. But the simple way to say it is that if your leverage is above 1:100, you will have less margin requirement. It means you will have enough space to operate. But if your leverage is 100 and below, the 100 is the standard. 1:100, okay? 1:100 is the 2%, okay? But that also depends on what broker you are using. Some brokers will say the 2% is the standard. Some will say maybe 2.5. Some will say otherwise. So in order to make it clear, let me give you the last slide of this. So the last slide here says that you may see margin requirements such as 0.25%, 0.5%, 1%, 2%, 5%, 10%, or higher, depending on the leverage of your account. So I'm going to explain this, the last part here, in my next video. So the leverage that you will choose will determine whether your margin requirement is just 0.25% of your account, or 0.5% of your account, or 1% of your account, or 2% of your account, or 5% of your account, or 10% of your account, or even higher than that. So I'll be doing that video. The leverage video will come very soon. I think it should be the next video after this, so that at least you get to understand things better. Once again, my name is Kofi, your admin. Thank you for doing the watching. Subscribe to this channel. More videos are coming. I'm taking my time to explain some of these things because you need to understand it. That is the technicality. Forex trading is not just about theory. It's about practicals and understanding the game the way it is. And that is what I stand for. All right? So I'm here for that all the time. Thank you.